Let's talk about the biggest prediction game in human history. It runs 24/7 all over the globe. The financial markets. We're talking trillions of dollars, moving at the speed of light, all riding on a collective bet about what's going to happen next. It's a world of unbelievable opportunity, for sure, but it's also filled with overwhelming noise and just brutal competition. Now, most people jump in like a gambler at a casino. They're running on gut feelings, hot tips, and a whole lot of hope. But what if there was a better way? What if you could step into this arena, not as a gambler, but as a scientist? Well, that's exactly the revolution financial machine learning is bringing to the table.
So, this brings us to a big question, the one that's been debated for 100 years. Are financial markets actually predictable? For decades, if you asked an academic, you'd get a loud, clear no. You see, the dominant theory was the efficient market hypothesis. The basic idea was that all the information out there is already baked into an asset's price. That means any future move is basically random, a coin flip. And trying to predict it, a total fool's errand. But things are changing. The explosion of massive data sets and incredible computing power is forcing us to look at this old question in a new light. The real game now isn't asking if markets are predictable, it's asking how much, for how long, and with what kind of tools.
And to really get a handle on the power of machine learning here, we've got to start with a huge shift in perspective. And for this, we're going to lean on some brilliant work from a survey on financial machine learning by Professors Brian Kelly and Da-Cheng Xu. They argue we need to see finance for what it really is at its core. You see, every single decision, every price on the screen, every trade, it's all an act of prediction.
Now, you see this on the screen? Price equals prediction. It looks simple, right? But believe me, this idea is an absolute game changer. You remember that old formula from your first finance class? The one where a stock's price is all its future cash flows discounted back to today? Well, that's not just some dusty textbook equation. It's a forecasting model. It means every single person in the market, from the giant hedge funds down to you and me, is making a prediction. The price you see flashing on your screen, that's just the market's consensus forecast. And that changes everything. Because it means you don't need a magic crystal ball. To win, you just need a forecast that is consistently, even just slightly, better than what everyone else thinks.
Okay, so if that's all it takes, why isn't everyone rich? Well, because building that better forecast is one of the toughest challenges you can imagine. First up, the sheer amount of information is just insane. We're not talking about price and volume anymore. We're talking hundreds of accounting metrics, macroeconomic data, news articles, analyst reports, heck, even satellite images of parking lots to predict retail sales. It's a fire hose of data. Second, how does all this stuff actually connect to future returns? Is it a simple straight line, or is it some complex, twisted, nonlinear mess that changes all the time? We have no idea. And finally, here's the real killer. The signal-to-noise ratio is just awful. Finding a true, repeatable signal in the market is like being at the Super Bowl and trying to hear one person whisper from across the stadium. The whisper is there, but it's buried under the roar of the crowd.
So with a challenge this massive, it's no surprise that the people trying to solve it have split into two camps, two competing cultures. The legendary statistician Leo Bremen described this perfectly, and it really is like a battle for the soul of modern finance.
So, in one corner, you've got the traditionalists, the econometricians. They use what are called structural models. They start with a beautiful, elegant theory about how the world should work. Something like riskier stocks ought to produce higher returns. Then they build a simple little model to test that one specific idea. They are obsessed with finding the why. But in the other corner, you have the machine learning crowd. They use prediction models. They don't start with a theory. They start with a mountain of data. They unleash these incredibly flexible, powerful algorithms and basically just say, go find whatever works. They are relentlessly focused on one thing, the what.
And this quote from Bremen just hits the nail on the head. It perfectly explains why this prediction-first approach is taking over. His point is brutally simple. When you build a model based on your pet theory, your conclusions are only as good as that theory. And what if your beautiful theory is just a little bit wrong? What if it doesn't quite capture the messy, irrational reality of markets? Well, then your conclusions and your trades could be catastrophically wrong. In a world as complex as finance, maybe, just maybe, it's smarter to let the data speak first before we start telling it what it's supposed to mean.
And this brings us to one of the wildest, most counterintuitive ideas in all of modern machine learning. It's something that completely turns decades of statistical common sense on its head, and it's right at the heart of why these new models are so incredibly powerful.
Okay, so for generations, anyone in this field has been taught one golden rule: keep it simple. Occam's razor. The simplest explanation is usually the best one. In modeling, that means you always want a model with fewer moving parts. Why? Because you're trying to avoid the number one sin, overfitting. Overfitting is the siren song that has wrecked countless strategies. Think of it like a student who crams for a test by memorizing the exact answers to the practice questions. They'll ace the practice test, right? But give them the real exam with slightly different questions and they'll bomb it. They didn't learn the concept, they just memorized the noise. That's overfitting.
But here's the radical question. What if that's not the whole story? What if, in a place as chaotic as the financial markets, our fear of complexity has actually been holding us back? What if, just this once, complexity is actually our friend?
This phenomenon is called double ascent, and it's mind-bending. Picture a chart of your model's real-world performance. As you start making it more complex, performance gets better. Great, then you reach a point where performance suddenly tanks. That's the classic overfitting zone. And for 50 years, the advice has been, stop, go back, your model is too complex. But here's the magic. If you ignore that advice and just keep jamming in more and more complexity, way past the point of no return, something incredible happens. Performance stops getting worse, it bottoms out, and then it starts to climb again, often soaring past where you were in the first place. The chef analogy is perfect here. A few too many chefs in a small kitchen is a disaster. That's overfitting. But if you keep adding complexity, you're not just adding chefs, you're building a massive, state-of-the-art industrial kitchen. With enough scale and the right organization, this hyper-complex system suddenly starts producing incredible results. That's what these massive models like deep neural networks are capable of.
Now, this is way more than just a cool statistical theory. This paradox has a direct, measurable, and honestly a pretty astonishing impact on the bottom line. This is where the theory turns into actual portfolio performance.
So what does this look like in the real world? The researchers put it to the test. They built portfolios where they'd buy the stocks their models predicted would do best and sell short the ones they predicted would do worse. A strategy run by a complex, three-layer neural network delivered an out-of-sample annualized Sharpe ratio of, get this, 2.36. Now, to put that number into perspective for you, the Sharpe ratio is the report card for risk-adjusted returns. A Sharpe of 1 is considered really good. A classic quant strategy might get a 0.8, maybe a 1.2 in a great year. A Sharpe ratio over 2? That is world-class. That's the kind of performance that legendary hedge funds are built on. This isn't just a small improvement, it's a quantum leap, and it's driven by embracing complexity, not running from it.
So, after all of this, what's the big takeaway? Well, the message from all this incredible research is crystal clear. The future of serious investing doesn't look like some frantic day trader or someone trying to read tea leaves on a chart. It looks like a disciplined, rigorous, scientific laboratory. So here it is, the playbook for the modern trader. First, reframe your goal. You're not looking for certainty. You are in the business of building a better forecasting model than the rest of the market. Second, embrace the chaos. Use big, messy data sets and models that are flexible enough to find those hidden, weird patterns that simple models would totally miss. Third, stop being afraid of complexity. That double ascent curve we talked about, that's your permission slip to explore those bigger, more powerful models, as long as you're smart about how you do it. And fourth, and this is the most important rule of all, be absolutely ruthless about testing. The only thing that matters is how your strategy does on data it has never, ever seen before. That means you have to keep a final, sacred, out-of-sample data set locked away, and you only touch it once. Anything less is just lying to yourself. In the end, financial machine learning isn't about finding some magical algorithm that just prints money with no risk. That's never going to exist. What it is about is a fundamental shift in mindset. It's about humility, knowing that the market is so incredibly complex that we'll never fully understand it. But it's also about empowerment, using these amazing new tools to build a more detailed, more accurate map of that complex reality. A better map doesn't mean there are no dangers ahead, but it gives you a powerful edge to navigate the terrain with more skill. It lets you trade like a scientist, not a gambler. So the only question left is, what map are you building?